Well, let's take a look at the Chapter 6 homework. So I'm on the Chapter 6 computational exercises. So in your ebook, just go to Chapter 6 and take a look at the computational exercises for that. And then from there, or just take a look if you've got the printed book. I know a lot of you have the loose leaf or hard copy too. It's on page 30 of Chapter 6. So either way, we'll get you there and you'll be in good shape. So the first one here, computational exercises for Chapter 6, question 25. During the year, Natcatcher, E&P of $1 million, distributed $200,000 each to Brandy and Ewan in redemption for some of their Natcatcher stock. The two shareholders acquired their shares 5 years ago. Each shareholder is in the 32% tax bracket. Each had a $45,000 basis in the redeemed stock. So letter A, assume the distribution to Brandy is a qualifying redemption. Determine Brandy's tax liability. Okay. So for this one, for Brandy, it's qualified. That matters because it's a qualifying one. It's treated as a long-term capital gain. Okay, so $200,000 minus a $45,000 basis. So I'm just going to go to Excel, 200 basis of 45. So you can all do the mental math here and go, obviously that is 155,000. And then they mentioned that because this is qualifying, we get the preferred long-term rate. And I don't know if they told us the rate or not. If we go back to the question, they don't tell us the rate. The book uses 15%, so 15% is the rate, the long-term capital gain rate. So 15% times 155 is 23,250, and that's the tax that Brandy will pay, 23,250. And then the question goes back and asks us about Ewan, non-qualified. So because it's non-qualified, basically it's taxed as a dividend, the entire amount. So now, because it's non-qualified, it's treated as a dividend, but you don't get to reduce the basis. Okay, so it's essentially just receiving a $200,000 dividend times 15%. So for Ewan, the second one, I'm just going to take 0.15 multiplied by 200,000, and now the tax is 30,000. Okay, so Brandy got the basis reduction, paid 15%. Ewan did not get the basis reduction because it's not qualified. Okay, so take a look at question 26. Rosalie has owns 50% of the outstanding stock of Salmon Corp in a qualifying stock redemption. Salmon distributes $80,000 to Rosalie in exchange for 1/2 of her shares, which has a basis of $100,000. Compute the recognized loss, if any, on the redemption for Rosalie. And so you have to kind of think through what that looks like. So we have for Rosalie $80,000 in exchange for 1/2 of her shares, basis of 100. Okay, so essentially we can all do the mental math and go 100 basis 80,000 received equals a $20,000 loss. Okay, so the answer to 26,000 is a 20,000 recognized loss. Now the reason for that is that since Rosalie does not own directly or indirectly more than 50% of Salmon stock at the time of redemption, she cannot disallow a loss recognition. So it's because she's at 50% or lower, she just simply treats it as a recognized loss of 20,000. Question 27, Dirk owns 250 shares of stock in Rose. The remaining 750 are owned as follows: 150 by Dirk's daughter, 200 by the aunt, and 400 by a partnership in which Dirk has an 80% interest. So how many shares does Dirk own directly or indirectly in Rose Corp? So you kind of think of that straight line. Your kids and your parents are kind of have that straight line, what that is. So Dirk's aunt would not count towards the number of shares. So for Dirk, we have to think through what he owns. So let's go with the 250 directly. That's what he owns that. He owns 150 from his daughter. We can count that. His partnerships owns 400, but only 80%. So he owns 80% of the partnership. So 400 times 0.8. So the sum of those three is 720, and that's the amount of shares that Dirk owns. We do not include the shares from the aunt because she's not a direct line family member. Question 28, Indigo wants to transfer cash of 150 or property worth 150 to one of its shareholders, Linda, in redemption transaction to be traded as a qualifying stock redemption. If it distributes the property, the corporation will choose between two assets that are each worth 150, no longer needed in the business. Property A, basis of 75, or property B, basis of 195. So you can kind of recognize here on property B, they're upside down on it, and property A, they're not. So letter A, compute Indigo's recognized gain or loss if it distributes property A in redemption of Linda's shares. So for question 28 for A, the distribution of property A is a recognized gain of 75. The fair market value of 150 minus a 75,000 basis. Okay. Gains and losses. Under this provision, gains are recognized but not losses. Okay, because this qualifies as what they call a Section 311 property. For letter B, that's the other property that's upside down. It's a 150 fair market value minus a basis of 195. So we can go through the math and go, it's a 45,000 disallowed loss. So gains but not losses are recognized on that kind of property. Letter C, compute Indigo's recognized gain or loss if it sells property B to an unrelated property, then distributes the sale proceeds in redemption of Linda's shares. So that's obviously what they should do. That result in a $45,000 recognized loss, assuming they sold the property for $150 with the basis of $195, then they have a $45,000 loss that they can then do recognize. So the key is, if you're distributing lost property, sell it, give the money to Linda. Okay, so that's what they should do. Or distribute property A, either way. Question 29, Carmel Corp has 5,000 shares of stock outstanding in the qualifying stock redemption. They distribute 145 in exchange for 1,000 shares at the time of the redemption. Carmel is paid in capital of 800,000 and E&P of 300,000. Calculate the reduction to Carmel's E&P as a result of the distribution. So it mentions here that this was qualified. E&P, I'll just tell you what the answer is, but I'll show you the math. E&P is reduced by 60,000, the lesser of the 145 distribution amount, or the 60,000 ratable share of E&P attributable to stock redeemed. Okay, so remember that they've got 5,000 shares, and 1,000 is being redeemed. Okay, so 145 is one number to compare to, the 145, and then 1,000 divided by 5,000 multiplied by the E&P of 300,000. So let's do 300,000. Then my E&P is the ratio is 1,000 shares divided by 5,000 shares. Okay, and I can do that ratio, 1/5, we know it's 20%, times 300,000 would be 60,000. Okay, so 60,000 is lower than the other number, which was the 145 right here. So I used the 60, the lower of the two. Question 30, it says here Sunset Corp with E&P of 400,000 makes a cash distribution of 120 to a shareholder. The shareholder's basis on the Sunset stock involved is 50,000. Determine the tax consequences of the shareholder. The distribution is non-qualified. Let's take a look at that one first. So if it's non-qualified, then the distribution itself, the 120, is all treated as dividend income. Okay, so for 30A, dividend of 120. Capital B, determine the tax consequence if it's a qualifying stock redemption. Then we have a capital gain. And what we do is we take the 120 minus the basis of 50, and then we have a capital gain of 70. And then letter C, determine the tax consequence of the shareholders of the distributions pursuant to a complete liquidation. Same story. Complete liquidation is we have a capital gain. We have the 120 minus the 50 for a capital gain of 70. So letter A is 120 dividend. B and C are both 70,000 capital gains. In question 31, pursuant to complete liquidation, Carrot Corp distributes to its shareholders a real estate held as investment, basis of $650, fair market value of $880. Determine the amount of gain or loss recognized by Carrot on the distribution if no liability is involved. So let's look at letter A by itself. So value is $880. Basis of $650. We can do the mental math and go, that's $230 gain. And so it's really simple. Letter A is just simply $230. It's a complete liquidation. There's no liability. We sold the property for fair market value. Okay. Letter B, determine the gain or loss recognized by Carrot in the distribution. The real estate is subject to a liability of $690. Okay, so now this real estate has some kind of a mortgage or something on it worth $690. In this one, in letter B, we still have a gain recognized of $230, the $880 minus the $650. And here's the reason why. There's a rule about this. A distribution and complete liquidation generally results in recognized gain or loss of the property as if the property were sold at fair market value. Then here's the caveat. If the property is distributed subject to a liability, the fair market value in the deemed sale cannot be less than the amount of such liability. So the liability of $690 is less than the fair market value. So therefore, we recognize a gain the same amount as letter A. Okay, the key is that the liability was less than $880, so that's why it's still a gain. Letter C, now it says determine gain or loss on the distribution if the real estate is subject to a liability of $885. Now the gain recognized is different, but not that much different. It's $235. The answer is $235. So the answer to A and B was $230. The answer to C is $235. So we know that we have this $885 liability, and we've got the fair market value of $880. So fair market value $880, liability $885. And so what we do then is we take the liability amount of $885, we subtract that from the basis to get $235. So I'm just going to show you the math here. So $885 of liability, basis of $650, difference is $235. So the answer is $235. Whoops. I think I did multiply, not minus. There we go. Okay, $235. Okay, so that was 31. So it's $230, $230, $235, all capital gains. Question 32 is Osprey Company. Osprey Corp stock is owned by Pedro and Pitro, who are unrelated. They each own 50%. Osprey has the following assets, none of which were acquired in 351 contribution to capital transaction, distributed in complete liquidation. So cash, land, and equipment. Assume that Osprey Corp distributes the land to Pedro. So Pedro gets the land right here, and cash and equipment goes to Pedro. Determine Osprey's recognized gain on distribution of the land. So take a look at the land here. You can see fair market value of $440, basis of $200. The difference is $240. So Osprey has a gain of $240 on distribution. Liquidating distributions generally result in recognized gain or loss as if the property were sold for its fair market value. Okay, so that's the 240 capital gain. Letter B, determine Osprey's recognized gain or loss on the distribution of the equipment. And take a look here. So we've got the cash is 300, and the equipment has a basis of 250 and fair market value of 140. So you can take a look and see the difference there is 110. So Osprey records a loss of 110. Okay, so that's the key there. Number 33. On January 4 of 18, Martin Corp acquires 2 properties from a shareholder. It says solely in exchange for stock in the transaction that qualifies under Section 351. The shareholder's basis, the fair market value, and the built-in gain or loss of each property are. You can see what those are. Martin adopts a plan of liquidation later in the year and distributes property to a 30% shareholder when the property is worth $350. Compute Martin's basis in the property 1 and property 2 as of January 4 of 2018. So Martin has a carryover loss of $300,000 for property 1. Okay, carryover loss of $300,000. For property 2, the basis step-down rules apply. Martin's basis in property 2 is $475. 475 is 525 carryover basis minus a $50,000 built-in loss. This loss right here. Okay, so that's a little bit complicated, but that's what they've got. For letter B, what's the realized and recognized loss on liquidating distribution of property 2? Realized loss of 125. Fair market value is 350 right here, minus the 475 step down depreciation, step down basis, I should say. And then the built-in loss limit also applies to disallowed loss that was inherent in the property on the date acquired after considering the step-down rule. Question 34 is Green Corp. Assets are valued at $920 after payment of all corporate debts, except for $134 of tax payable on net gains it recognized on the liquidation. Bruno is an individual and the sole shareholder of Green, has a basis of $280 in his stock. Compute the gain or loss recognized by Bruno on the liquidation of Green Corp. So kind of look at the numbers here. We've got a value of $920 up here, and so we have a realized amount that's different than that, though. So we take the fair market value of $920 and we subtract the liability of $134, and then we subtract the basis. So it's $920 minus $134 minus $280, and that equals the answer, which is $506. Let me just kind of give you the math on that one just so you can see it better. So it's the $920 minus the liability of $134 minus the basis of $280. So the sum of those is the answer, which is a gain of $506. Okay, question 35 is the stock of Quail Corp is held as follows: 85 by Pheasant, 15 by Gisela. Giselle's an individual, Pheasant Corporation. Quail Corp is liquidated in December of the current year, pursuant to a plan adopted earlier in the year. At liquidation, Quail Corp has assets with a basis of $730 and fair market value of $1. Quail Corp distributes the property prorated to Pheasant and to Gisela. Compute Quail's recognized gain or loss on the distribution of property to Pheasant. The same thing in the distribution to Gisela. So let's look at letter A first. Liquidation of Quail is a parent sub-liquidation. Therefore, there is no gain or loss on liquidating distributions to pheasant because of it's just basically capital. You're just kind of moving dollars from one company to another that one owns the other, so there's no gain. Now, it's different though when we transfer to Gisela because she's an outside individual. There's a gain of $40,500,000. So there's $1 million right here. So that $1 million fair value, we subtract the basis of 730, and we multiply that by 15%, which is the ownership percent. Okay, so let's just go and do that here. So we'll take $1 million. I'm just rounding, I'm just calling 1,000 a million, minus the basis of 730. So the book value left over is 270. I'm going to multiply that by 0.15%, which is Gisela's portion. So the answer would be 40,500. 40,500. So B or A is 0, B is 40,500. For question 36, Blush Corp owns long-term bonds with a basis of 1.3 million of its sub Brass, acquired at a discount upon liquidation. Brass, pursuant to section 332, Blush receives a distribution of 1.5 million. The face amount of the bonds determine Blush Corp's recognized gain or loss on the distribution. So they recognize a gain of 200,000. Okay, a gain of 200,000. 1.5 million realized minus a basis of 1.3. Question 37. Goose Corp has a basis of 2.4 million. In the stock of Swift Corp, a wholly owned sub acquired 30 years ago. Goose liquidates Swift and receives assets worth 2 million, basis of 1.7. Determine Goose Corp's recognized gain or loss at recognition. Question 37, part A. Goose recognizes no gain or loss on liquidation under section 332. Goose's basis in the Swift stock disappears. The 2.4 million disappears. B, determine Goose Corp's basis in the assets received in liquidation. It receives the basis of 1.7 million that was received. Okay, so that was 37. And then there's one problem I want to work with you. The next problem, which is problem 38. This is Teal Corp. Teal Corp has E&P of 2 million, distributes property with a basis of 150 and a fair value of 400,000 to Grace, who owns 15% of the outstanding shares of Teal. So letter A, what are the tax consequences to Teal and to Grace if the distribution is a non-qualified redemption? Okay, so Teal's side of it and Grace's side of it. So for Teal Corp, it has a taxable gain of 250. You can see the market value of 400, the basis of 150. The difference is 250. The gain would be ordinary or capital, depending on what kind of property was transferred. We don't know, but it would be either ordinary or capital. The E&P of Teal Corp would be increased by 250, the amount of gain to Teal, and then also decreased by the 400,000 fair market value of the property distributed. Teal's E&P would be decreased by the amount of tax due when the gain recognized, and then Grace would have dividend income of 400,000, and she'd receive a basis in the property of 400,000. Okay, so that's the issue for both sides of that. For letter A, for B, the tax consequences in part A if Grace is a corporation. So instead of being an individual, now Grace is a corporation. So for Teal, the same thing, same story for Teal on Teal's side. What's different though, if Grace is a corporation, dividend income of 400,000, and 50% of that or half of that would be taxable because of the dividends received deduction. Okay, because you own less than 20%, you get a 50% dividends received deduction. Grace Corp receives a basis of 400,000. receives $400,000 in dividends again, but only half of those dividends are taxable. Letter C, what are the tax consequences of Teal and to Grace of the distribution is a qualifying stock redemption. And assume that Grace's basis is $90,000. So the Teal would be the same as A, except that Teal's E&P is reduced by the rateable share of its E&P attributable to the stock redeemed. We don't know what that is because we don't know what the percent is. Grace would have a capital gain of $310, $400,000 value received minus the $90,000 basis, so a $310,000 capital gain, and then Grace has a basis of $400,000 in the property. Letter D, the tax consequences in C if Grace is a corporation, exactly the same. For Teal's side, the same. For Grace, it has a capital gain of $310, 400 minus 90, and a basis of $400,000. And then letter E, if the parties involved could choose from among the preceding options, which would they choose and why? Assuming Grace is an individual, she would choose the qualifying stock redemption, which is item C, because it's only a gain of $310 that she has to pay tax on. Okay. Okay, now if she's a corporation, obviously then she wants a dividend, right? If she's an individual, she wants the gain. If she's a corporation, she wants the dividend. So that's kind of how that works out. So just really the point of that is to understand the differences between who's receiving the distribution and if it's qualifying versus non-qualifying. Okay, that's it for the Chapter 6 homework. As always, if you have questions, just let me know.